Hello friends, my name is Deepak and today in our studio I have Sanjiv Gupta CPA with us. He's a prominent certified public accountant from Fremont, California. Sanjiv ji, welcome to our studio.
Good morning, Deepak ji.
So Sanjiv ji, I know a lot is going on with the Sanjiv Gupta CPA firm lately. We have a new office coming up, I heard, in Pleasanton.
Yeah, hopefully we'll get the lease signed up in Pleasanton.
Okay, any estimated date when you guys are planning to open up there?
Well, we will open as soon as possible, hopefully by month of November.
All right, so there you go, friends. If you're planning on coming to office in Pleasanton, there might be an option for you. We do have an office currently in Sunnyvale as well, so you guys can come to Fremont, Sunnyvale, and hopefully by early next year you can also come to Pleasanton. There's a lot more other things are going on with our firm as well, right? We have an event coming up.
Yeah, so we are going to do a webinar as we do. We have been doing webinar for a long time. So this webinar is currently titled, as you know, Obamacare. So tax impact of Obamacare for businesses and individuals. That's happening on October 26th. And we are doing this seminar, Annual Wealth Summit 2013.
So that would be very good for you guys. If you guys are planning to come out, it's a full day event. It's going to be happening at Baltimore Hotel in
Biltmore Hotel in Santa Clara.
In Santa Clara, okay.
And the timing is 10 to 4. And yeah, and they can call us. They call our office number 510-825-7563.
So that might be a great opportunity to come out there and meet with Sanjiv in person and obviously check out various presentations. Ladi Juti will be there with us as well. He will talk about estate plan and financial planning.
Yes.
So that will be a great event. Once again, it's coming up on
November 17th.
November 17th. So you probably want to mark that date down. November 17th it is next month. So it's a full day event. You can register on sanjivcpa.com and make sure you get your tickets. I think we did this last year, if some of you guys joined us back then, and it was a sold out event. We were completely sold out and we had folks and we had to get some extra chairs from outside. So hopefully this year we can manage much more better if you register well in advance. And Sanjeev ji, if I'm not wrong, you're also arranging food there that day.
Definitely. Park Baluchi food. Yeah, Park Baluchi is there, the top-notch restaurant in Mountain View.
So there's a restaurant from Mountain View, Park Baluchi. They will be there, and they are the one who will be providing the catering for that day. So it sounds like a fun day. But anyhow, that's enough about what's going on with Sanjiv Gupta CPA firm. Let's talk about today's topic. So today we wanted to talk about FBAR. We wanted to talk about people who have paid some taxes in India, or for that matter Canada or Mexico or some other country. And I heard there are provisions in the United States that help you avoid paying that double taxation. Am I correct, Sanjeev ji?
Yes. So what happening is there is a double tax avoidance agreement US has with a lot of countries. Let's say India, Australia, Canada. So under that provision, under that agreement, what happens is if you are paying any tax in a country outside US, let's say India, you can get a foreign tax credit. Now you can't get for all the tax that you pay there. It's not a credit for all the taxes, because the IRS code says that for any tax you pay outside, it has to be, the income should be foreign sourced. It cannot be a US sourced. So a distinction needs to be made between foreign sourced and US sourced income. For example, I want to give an example here. Let's say the capital gains. Now in India, if you sell any stocks and it's short-term gain, less than 1 year, there is a short-term gain, you are subject to ordinary tax rates in India, 20% or 25%, whatever your tax rates are. If you sell more than 1 year, if you hold a stock and sell it for more than 1 year, then the tax rate is 20% in India. Here, what happens is the US consider that income as a US sourced, not as a foreign sourced. So in India there is no tax on the long-term capital gain on sale of shares, but there is a long-term capital gains tax on the sale of properties, but not on equity stocks or debentures. So what happens is, because you pay tax on the short-term gain in India, you are looking for foreign tax credit, you file the form 1116, but US, as per the IRS rules, that is considered as not a foreign source but a US source, so will not get any credit.
And that's very interesting, Sanjeev ji. So friends, I want to make a point here what Sanjeev ji is saying. It's quite easy for somebody to just simply make a mistake by claiming this credit, and yet they might find out that they don't actually qualify for this credit because somebody made a...
Yeah, because as I said, it's that income is considered as a US source, not a foreign source, and that foreign tax credit 1116 can be claimed only for foreign source income, not for a US source income. So one has to make a distinction between foreign source and US source. So when you claim any foreign tax credit and you avoid any IRS questions on that, you need to make a statement highlighting the foreign source, US source, and different types of income. Let's say salaries, let's say rental income, the interest, dividends, and then classify them properly according to US source or foreign source, and then see whether a particular income qualifies for a tax credit. It's not automatic.
Makes sense, Sanjeev ji. So, friends, I want to make sure you guys are quite clear on this. It is quite possible that you must have earned the income through different sources. Maybe it's a money sitting in a bank account. Maybe you have a business there. Maybe you have stocks. Maybe a life insurance. So many different ways you could be possibly earning your money in India, or for that matter, any other country. And then when it comes down to doing your taxes next year, you might want to take advantage of this foreign tax credit, but you can only do so if you properly classify those incomes. And that's a quite bit of a challenge. Someone who don't understand how to classify those different income into different categories might make an easy mistake. And Sanjeev ji, if I'm not wrong, even the online forms these days, these online softwares, it's probably quite easy to make a mistake there as well, right?
Because like I said, this online stuff, they don't categorize those income as foreign source or US source. They will just take what you're inputting into the system according to your knowledge, according to your experience. So you definitely need a tax professional, a CPA, who has the understanding of both sides. See, knowing it is different, but working in it, we have worked in that area, right? I have practiced in India for 15 years. I'm FCA, so I hold that license. So I know the ins and out of how the Indian tax rules works on that particular area. So how to claim it, how to depict on the US tax returns. If you make one silly mistake, and IRS, because it's a credit, and credit is different from deductions. It's dollar to dollar credit. It reduces your taxable income. So if you don't do it right, you're waiting for something to happen from the IRS, and I know people have lost a lot of cases because you're not able to substantiate to the IRS what's going on. So it's very critical that when we claim any foreign tax credit, we have to substantiate. We have to have a good work papers showing foreign source or US source and applicability of deductions of whether that makes sense to claim a foreign tax credit or not.
And Sanjeev ji, this might be a good time to also remind our viewers that it's also important to file your Indian tax return.
Oh, definitely. See, the number one thing that the double tax avoidance agreement says, if whenever you have income in any country outside US, you need to file a tax return. That's the most important thing. So I know the Indian rules, like if you don't have income above, let's say in the current scenario, 1,50,000 rupees. If you have income more than that, you need to file a return. If you have income less than that, you don't need to file a return. But because of the double tax avoidance agreement treaty, that says we need to file a return, it's better for people to file a return, maybe pay some tax, maybe 10 rupees or 100 rupees, just to keep the return in place and show the proper computation. Once you do the proper computation, definitely you can claim the foreign tax. Again, it's subject to the rules that it should be a foreign sourced income, not a US sourced income.
And Sanjeev ji, even through our website, as well as phone calls into our radio show, as well as several emails that I received, one of the common things that is especially happening with our Indian community these days is rental income.
Oh, yeah.
I mean, properties on boom in India. People are buying property left and right, and a lot of these properties are being rented out for almost $1,000, $1,500 a month. What do you have to say in regards to that?
Well, the thing is, you know how the system works in India.
And that's exactly why I asked the question.
When it comes to the rental income part. So, first of all, to have a proper declaration of income, we have to have a proper rental agreement like we do here, right? Then we have to see how much deduction we can claim in India on the rental income. Now, in India, there are statutory deductions. 30% of the rental income can be claimed as deductions on, we call it as standard deductions. You can claim as deduction on the tax return in India on that income, but not here. Yeah, of course, you can claim actual expenses, but if they are less than 30%, you can go for standard deductions. And then there is a tax deducted at source, 10% to 20% on that income in India, which nobody is paying. A lot of people omit to pay those taxes due to lack of knowledge, or they don't go to his chart accountant, or the chart accountant is not aware of the rules and regulations. So those things happens. But as I said, in India you can file the back tax returns always. But it's advisable for the US residents, citizens or green card holders When you have a rental property in India, look at the rental agreement, right? File the tax return showing that income, right? Depict that income on the US tax return the same way like you're renting a property here in US with all the expenses. Well, you can claim if you are moving, if you're going to India and you have a rental property, you can claim the travel expenses. So that is addition to what you can show on the Indian tax returns. So definitely you can do a lot more things. Then the basic important part comes here, the depreciation, because it's a foreign property, right? The normal years is not 39 years, it's 40 years. So how to compute the different values like land, building cost, that is important area. So that where our experience come into picture, and definitely we have helped a lot of clients in that area to claim the maximum deductions, and um, IRS is okay with it. So we have been very lucky in going through all these deductions.
And Sanjeev ji, if somebody wants to file their tax return in India, is that something they would have to travel to India to do that?
No, it's online. Income Tax India department. If you just Google online, you can Google nowadays anything.
Of course.
So just Google that website, Income Tax India, and if you have a PAN number, just put your PAN number there. If you don't have a PAN number, you can get one PAN number. There are a lot of websites which are doing the PAN numbers. Be patient with the, you know how the system works in India. So there's a delay and tracking and this and that, but you will get one fine day at PAN number. Just input a PAN number and you can do online. India assessment is very fast. It's just
Excellent.
filing.
And if somebody needs help, is this something your office might be able to help?
Yeah, so
as well?
we have like we are associated with our firm in India. My brother practices in India in New Delhi. She's a chartered accountant. We have a long-standing firm in India, so he can definitely help in this area. So yeah, we can provide all the services. Now coming back to the sale of property, which we talked about, the rental property, not sale of property. So rental property, we can say that one has to be cautious to declare that income, because what happens is that rental income must be, you're going to put that money somewhere. If you put in you cannot have a regular checking saving accounts. You have to have a non-resident ordinary rupee account, non-resident external account, or FCNR account. You cannot have a fourth or fifth or sixth account like a regular checking, like, because you are no longer resident. When you put that money in this accounts, then we have the filing of FBAR. FBAR requirements come into picture, and then we have to report the interest income in case you make interest income on that. So all these things are linked together, and then we think about repatriating that money from there to here. So that's also we have to consider. If we have to repatriate that money here, we have to go through proper channels and we have to file proper returns.
So friends, let me clarify what Sanjeev ji has said here, because we get a lot of questions on this particular subject, and I know it is quite complicated. So idea is simple, that you have some sort of investment in India. Obviously, through that investment, you're earning some sort of funds, and those funds needs to be properly classified into different categories, so that way you can take advantage of tax credit here in the United States. More importantly, you also need to file a tax return in India. You can do that online by just Googling Indian tax return, or you can always come to Sanjiv Gupta CPA firm here in Fremont or in Sunnyvale. Their office staff can definitely help you with that. In addition to filing the tax return, then you would have to file an FBAR here in the United States. That once again, Sanjiv can help you out with that as well. And once you have filed the FBAR, then it's just a matter of going forward, how do you plan things properly so you don't have to pay as much tax. One thing that is not so much related to a tax, but it's kind of important for you to know, is having a proper bank account in India, which Sanjiv kind of touched on that. And we'll do another segment. We do have a couple of blog posts on our website if you guys want to learn a little bit more about that. We have good contacts with several banks here in the United States, and we'll try to bring some of those up here in future segments for you. Maybe they can explain a little bit more about what different kind of bank accounts you can have. But you put all those things together, and I know it looks quite confusing, but at the end of the day, you will have a good night's sleep. So thank you so much for watching this segment. We'll be back with you in the next segment pretty soon. But Sanjiv ji, thank you so much for coming to our studio. We look forward to seeing you in your Pleasanton office pretty soon. And friends, once again, I want to remind you, go to sanjivcpa.com and sign up for our coming up webinar about Obamacare. That's very, very big this time. Sanjiv is going to help us demystify that. And in addition to the webinar, we also have a newsletter coming out that's going to cover Obamacare in quite a bit of detail. And so just watch the website. We should have details on that newsletter as well. So those are your two great opportunities to catch on latest going on with Obamacare. And in addition to that, we have another tax planning seminar coming up as a live event. So you probably want to look for that information as well. So there's a lot going on with us, but go ahead and watch some of our other segments. Hopefully you will catch some more important information. But till next time, thank you, and thank you very much for watching this segment. Goodbye.